Today we are going to deal with a new head, that is income from salary. Income from salary that is dealt in section 15 to 17 of the Income Tax Act that deals with the salary. But first of all, let us see what is salary. Any remuneration paid by an employer to the employee in consideration of the services rendered, that comes under salary. So remuneration paid by the employer to the employee in consideration of his services or in consideration for the services rendered, that comes under salary. There are certain facilities which are provided by the employer to the employee. For example, rent-free accommodation may be provided, free education may be provided in a school run by the employer to employee's children. The monetary value of these facilities, that shall also be included under salary. The monetary value of the services rendered, of the benefits or facilities provided, that shall also be included under salary. That shall also be taxable under the head salary. Now, Section 15 of the Income Tax Act deals with the incomes which are taxable under the head salary. Section 15 deals with the incomes which are taxable under the head salary. First is salary due from an employer or former employer to an assessee in the previous year, whether it is paid or not. Whether the salary is paid or not, that is immaterial. Salary can be charged to tax on due basis. Salary may be received from the employer, or it may be received from former employer. For example, suppose an employee has resigned from their service, then salary due for the services rendered at the earlier, that shall also be taxable under the head income from salary. That is salary due from an employer or former employer. Suppose if an employee retires from services, then any arrears of salary received from the employer, that shall also be charged under the head. That is what we have saying, that any salary due from an employer or former employer to an assessee in the previous year. Salary due in the previous year, whether it is paid or not, the payment of salary, that is immaterial. It can be charged to tax on due basis. The second point is the salary paid or allowed to him in the previous year by or on behalf of the employer or former employer. That is, salary paid in the previous year by or on behalf of the employer. It is not a must that the salary should be paid by the employer himself. It may be paid on behalf of the employer. For example, in aided schools and colleges, the employer is the manager, but the salary is paid by the government. There the salary is paid on behalf of the employer. Or former employer. Salary may be paid either by the employer or somebody on behalf of the employer or former employer, though not due or before it becomes due. That means even advance of salary given by an employer or former employer to the employee, that shall be chargeable to tax. Any advance of salary paid to the employee by the employer or former employer, that shall also be chargeable to tax. But one point you have to remember, if any advance salary is paid and included in the income of the assessee in the previous year, then it shall not be again included when that salary becomes due. Suppose salary for the 3 months, April, May and June, that is paid in the January itself, and it is included in the previous year in which it is received, then it shall not be again included when that salary becomes due. Next comes arrears of salary. Arrears of salary are allowed or paid or allowed to him in the previous year by or on behalf of the employer or former employer. Arrears of salary if not chargeable to tax in the previous year. Arrears of salary received by the employee, that may be received from the employer or former employer, or it may be received, it may be paid by on behalf of the employer, that shall also be chargeable to tax. So here we have seen 3 points, that is salary due from an employer or former employer by or on behalf of the salary due from an employer or former employer, then any advance of salary paid or allowed to him in the previous year, including advance of salary, then comes arrears of salary paid or allowed to him in the previous year by or on behalf of that. One thing you have to charge is salary shall be chargeable to tax only once. If advance salary is received and it is chargeable to tax in the previous year in which it is received, then it shall not be again chargeable to tax in the previous year when it becomes due. In the same way, if arrears of salary is received, that is charged to tax in the year in which it is received, then it shall not be, if not chargeable to tax, in the previous year in when it becomes due. That point you have to remember. Salary shall be advance of salary and arrears of salary shall be chargeable to tax only once. Now, what about salary, bonus, commission, etc. received by a partner in a partnership firm, from a partnership firm? Will it be regarded as salary? Of course, salary received by a partner is salary, but it shall not be chargeable under the head income from salary. It shall be chargeable under the head income from business or profession. That point you should remember. Salary, bonus, commission, etc. received by a partner from a partnership firm. The reason is the relation between the partner and a partnership is not that of an employer-employee relationship, that we shall see when we deal in detail. Now, where does the salary accrues? Where is the place of accrual? An income shall be taxable under the head income from salary if it is earned in India. If that income is earned in India, it shall be deemed to accrue or rise in India. Suppose a person employed in India goes on a leave to a foreign country and he receives his salary outside India during the leave period, of no doubt that shall also be chargeable, that shall be treated as income which is deemed to accrue or arise in India. That shall be deemed. Suppose a person having served in India, after retirement he goes and settles outside India. What about the pension he receives outside India? No doubt that pension shall be deemed to accrue or rise in India, because pension accrues at the place where services are rendered. Pension accrues at the place where services are rendered. However, there is one exception to that. That is, an Indian citizen who is a government employee and transferred to one of its offices and receives outside India will be liable to pay income tax to the Indian on his salary which he earns and receives outside India. Salary accrues at the place where services are rendered. Suppose an Indian citizen who is a government employee, he is working at an office outside India and is transferred to one of his offices outside India. He will be liable to pay tax to the Indian government on his salary which he earns and receives outside India, provided he is a resident. However, any allowances or perquisites received by that person, but that Indian citizen, for services rendered outside India, that shall be exempted from tax. However, an employee of a private concern or a non-government employee, he is transferred to a place outside India, to one of the branches outside India, and he is serving outside India, that salary shall not be treated as Indian income because he is serving. So the only exception is Indian citizens who are government employees and they are serving outside India, their salary shall be deemed to accrue or rise in India, but any allowance or perquisite received by those employees, that shall not be taxable. At the same time, if a non-government employee is transferred to one of the branches, suppose he is working in a bank and that bank has got a branch outside India, and he is working outside India, then that salary shall not be deemed to accrue or rise in India, and he will not be taxable to salary. Then there are certain points which we have to explain with regard to salary. Salary means every kind of remuneration received either by a government employee or a non-government employee, private employee or public employee, whatever be his status in the organization, all this comes under. For the purpose of income tax, there is no difference between the wages received by a laborer and the salary received by a high-paid official. As far as Income Tax Act is concerned, wages received by low-income employees of the lower category, and salary or high salary received by employees of higher grade, both comes under salary. What about foreign salary and pension? Salary and pension received from a foreign government, that is also taxable under the head salary. It is not a must that salary and pension should be received from Indian government, even if it is received from a foreign government. Next is relationship between employer and employee. That is very important in the sense that in order to constitute an income under the head salary, the relationship between the payer and the payee, that should be an employer-employee relationship. Employer-employee relationship should exist between the payer and the payee. Suppose a college lecturer receives remuneration for valuing papers from the university. Can it be charged under the head income from salary? No. Because the relationship between the employer and the employee, that is not of an between the lecturer and the university, that is not of an employer-employee relationship. A distinction should be drawn between income from employment and income from income from other sources or profits and gains of business or profession. So, second point, the point we have to every kind of remuneration received by an employee from his employer, that will be charged under the head income from salary. Suppose an employee does any work not connected with his employment, and he receives any remuneration for that, it will not be treated as income from salary. Suppose an employee who is taking tuition for employers' children, that is not in any way connected with the employment. He receives tuition fee from the employer for teaching employees' children, that will not be chargeable under the head income from salary, because that is not in any way connected with his employment. Next is salaries and professional income, where employment is merely incidental to the exercise of his profession, then income from such employment should be considered as professional income and taxable under section 28. Suppose a chartered accountant who is a practicing chartered accountant, he is getting monthly salary from one of his clients. Instead of he is given a fixed monthly salary or fixed amount by way of salary, then it will be charged under the head income from business or profession, and it shall be charged under section 28. It shall be charged under section 28. Or a practicing lawyer, he may be employed by a bank, or bank may be giving a fixed salary for appearing on behalf of the bank in the court. Can that salary be treated as salary, or will it be charged under the head income from salary? No. While exercising that income is earned merely incidental to exercising of his profession, that is received while he exercises his professional skill, then it will be treated as income from business and not under the head income from salary. Suppose perquisites or any other benefit or any other remuneration received from a person other than the employer, it will be treated as income from other sources, even if it accrued to the employee by reason of his employment. For example, suppose a college professor, he receives remuneration from the university for valuing answer scripts. That shall be charged under the head income from other sources, although that is incidental to the exercise of his, that is closely connected with his employment, but it is received not from the employer, it is received from. So any remuneration received by a person other than his employer, that will be charged under the head income from other sources. Suppose an employee retires from service, and any remuneration received by the employee after retirement from service from his employer or after cessation from employment, that is also taxable under the head income from salary. The reason is that that remuneration is paid, or that payment is paid by the employer for the past services rendered by the employee. That remuneration is paid for the past services rendered by the employer, then it shall be charged under the head income from salary. Next, pension. What about pension? Any pension received after retirement from service, that is also taxable under the head salary. Suppose a pension is earned and received abroad, that shall be chargeable only in the case of ordinary resident. That shall be taxable only in the case of ordinary resident. Whether that amount, that pension is remitted to India or not, that is immaterial. Only point you have to remember, that is pension accrues at the place where service are rendered. If pension is earned and received abroad, it shall be. Suppose pension is paid by a foreign government for services rendered in India, that is taxable in India. Pension paid by a foreign government for service rendered. The only point you have to remember is pension accrues at the place where services are rendered. If that employee was serving in India, that pension shall be deemed to accrue or rise in India. What about commuter pension? Commuter pension means instead of receiving pension, monthly pension, you will receive it in lump sum. That shall be, as far as private sector employees are concerned, commuter pension is fully exempted. Non-government employees, we can deal that in later. What about application of salary or voluntary foregoing? Suppose an employee is voluntarily foregoing his salary. He is rendering service, but he is not receiving remuneration. That will be treated only as application of salary. That is, will be treated as, and it will be chargeable to tax for the employee, because that salary has become due. Whether it is paid or not, that is immaterial. That when the salary becomes due, it shall be chargeable to tax. Suppose there is an agreement between the employer and the employee not to receive any salary, not to pay any salary. There it will not be chargeable to tax, because there is an apparent foregoing of fictional salary. Then it would not attract. For example, Suppose a physician, after retirement, he has agreed to work in a hospital run by a particular community without any salary. The agreement between the physician and the management is that he shall render voluntary service. Then there the salary, the fictional salary which he is eligible, that shall not be chargeable to tax. That will not be chargeable to tax. What about tax-free salary? Nobody can give tax-free salary. The tax-free salary here means tax on that salary will be paid by the employer to the department. In that case, the amount of salary received by the employee together with the amount of tax paid by the employer, that shall be included as gross salary. That is aggregate amount of net salary plus amount of tax paid on behalf of the employer. What about deductions by employer? Suppose there are compulsory deductions from salary. Compulsory deductions from salary. For example, Provident Fund, then insurance, then PF, Provident Fund contribution, then comes retirement benefits contribution. These are all compulsory deductions. When you compute the salary, you have to include the gross salary because these are all treated as application of salary. Suppose a college teacher is receiving salary after deducting his accommodation. He is staying in an accommodation provided by the college. He is taking food from the college hostel, and after that he is getting only net salary. He is getting salary after making all these deductions. When you compute the income from salary, all these deductions, they have to be added back because gross salary shall be taken into account. What about salary of a member of parliament or member of the legislative assembly? What about salary received by MPs and MLAs? No doubt, it shall not be included under the head income from salary, but it shall be included under income from, it shall be chargeable to tax under the head income from other sources, because the relationship between the government and the MP or MLA, that is not of an employer-employee relationship. Same is the case with salary of a partner. Any salary received by a partner from partnership, that shall not be charged under the head income from salary, but it shall be charged to tax under the head profits and gains of business or profession. What about family pension? I told you that pension received by an employee, that will be taxable under the head income from salary. What about family pension? On the death of the employee, his legal heirs or dependents may be receiving pension. What about that? It is also chargeable to tax, but it is not chargeable to tax under the head income from salary, but it is chargeable to tax under the head income from other sources. Now, what about dearness allowance and dearness pay? DA is paid to compensate the high cost of to compensate the rise in price level or high cost of living. When the cost of living index increases, DA is paid. This is included under the head income from DA, dearness allowance, that is paid to an employee in order to compensate the high cost of living. That is chargeable to tax. What about dearness pay? When the whole or a part of the allowance is converted to dearness pay, it becomes part of salary. Dearness pay, that becomes part of salary. Both dearness pay and dearness allowance, they are included in, they are chargeable to tax. Dearness allowance is paid to compensate the high cost of living. Dearness allowance is paid to compensate the high cost of living. Dearness pay means when whole or a part of the dearness allowance is converted to dearness pay, it forms part of basic salary. At the time of calculating retirement benefits, dearness pay is included under salary. Dearness pay is considered as basic pay, or dearness pay that becomes part of basic pay. So I shall explain it once more. Both the dearness pay and dearness allowance, they are chargeable to tax. But when a part of the dearness allowance is converted to dearness pay, that becomes part of the basic salary, and that shall be considered for computing the retirement benefits of the employee. What about due date of salary? In the case of government and semi-government employees, salary for a particular month is due on the first day of the next month. For example, salary for the month of June, that becomes due on the 1st of July as far as government and semi-government employees are concerned. So when you compute the salary, you have to remember, when you compute the income from salary, of course you have to take 12 months income. Then salary for the previous March, that shall be included in the current year's income, and salary for the current year's period, March, that shall be included only in the next assessment year. So salary for government and non-government employees, it becomes due on the 1st of next month. In the case of banks and employees of banks and non-government bodies, salary for a particular month is due on the last date of the month, last day of the month So in the case of bank and other employees, usually salary for 1 year, one previous year means salary from April to March. For government and semi-government employees, salary for 1 year means, one previous year means previous March to coming February. For example, this is the assessment year 2021. So salary for the previous year 1920 is, as far as government employees is concerned, salary for the month of March 2019 plus April, May, then comes up to February 2020. Salary for March 2020, that will be included in the next assessment year. But government and non-government employees or banking, then private sector employees, there the salary means salary from April to next March. Now, suppose if any part of the salary is surrendered to the central government, where an employee surrenders a part of the salary to the credit of the central government, the part of the salary so surrendered shall be exempted from income. Suppose an employee surrenders any part of his salary to the central government, then it shall be exempted from, the surrendered amount shall be excluded from his salary income. If any tip is received from the employer, that is also included in salary. Now let us see the definition of salary. Section 17, under Section 17, the following have been defined. Section 17, under Section 17, salary includes the following have been defined: salary to Perquisites. 3. Profit in lieu of salary. Profit in lieu of salary. Now let us see what is salary. Salary includes what? Salary includes A. Wages, annuity or pension. What do you mean by annuity? Annuity means annual payments. The dictionary meaning is annual payments. That is, while an employee in service, he takes an annuity, or sometimes the employee himself or employer may take an annuity. Then the annuitant, the beneficiary, will get annuity either monthly, quarterly, half-yearly, annually, or that depends upon the agreement. That annuity, that is also another form of pension. Annuity or pension. Then comes gratuity. Gratuity is received at the time of termination from employment. Gratuity. Then fees, commission, perquisites, or profit in lieu or in additional salary or wages. Fee, commission, etc. Fees, commission, then perquisites, or profit in lieu of salary. What do you mean by fees, commission? You see, an employee may be paid a commission on the basis of the turnover achieved, or on the basis of the sales achieved by him. That is commission. Perquisite we shall detail, and profit in lieu of salary, both are given in addition to salary or wages, that we have to deal in detail about this perquisite. And then comes advance of salary. Then comes leave salary. Now I shall explain one by one. Wages, wages. Then annuity or pension, I have already explained. Annuity or pension received by an employee, either from an employer or former employer. Not from an employer, but from former employer, that shall also be chargeable to tax under the head income from salary. Then gratuity. Gratuity is given in consideration for the services rendered. That is, then wages, bonus or commission. Then advance of salary. Advance of salary means, you can see here government employees, also private employees, they are getting advance of salary. That is salary for the coming period that will be received, that will be paid earlier. That is advance of salary. Then comes one more point I have to explain, that is, suppose an advance is given for purchasing a car or a motorcycle or a cycle. That is not that is a loan. That is not advance. That is a loan given, not advance of salary. Advance of salary means salary for the coming period that is paid now. When it becomes due, it will not be paid. Only the balance amount after deducting the advance shall be. There is any loan given for purchasing an asset, that shall not be included, that shall not be considered as advance of salary. Next is any payment of leave. Any payment received by an employee in respect of any period of leave not availed by him. Suppose an employee is eligible for leave. Employee is not taking leave. He is working instead of taking that leave. Then that leave can be surrendered. He is not actually availing the leave which is due to him, but he is not taking that leave, availing that leave. That leave salary received, that shall also be charged under the head income from salary. Now, an employee who is a member of a recognized provident fund. There are different types of provident fund. One is recognized provident fund. An employee is a member of a recognized provident fund. both the employer and employee can contribute to this provident fund. And on the outstanding balance, of course, interest will be paid. Suppose the employee can contribute as much amount as he wants. There is no restriction. But if an employer contributes more than 12% of his salary, employee's salary, that excess shall be included. That excess shall be included in his salary. That is, only up to 12% shall be exempted. In the same way, if interest credited is interest up to 9.5%, that is exempted. If it exceeds 9.5%, that excess shall be included. So what about recognized provident fund? Employee's contribution except 12%, employee's contribution except 12%, and interest credited in excess of 9.5%, that shall be included in employee's salary. If it is given in excess of that, it shall be included. Then, aggregate of all sums comprised in transferred balance. That is with regard to unrecognized provident fund, that we shall see. Or aggregate of all sums comprised in to the extent which is chargeable. That is, when an unrecognized provident fund is becomes a recognized provident fund, the balance standing in the credit of the unrecognized provident fund, that will be the balance that shall also be included under the head income from salary, that we shall deal later. The contribution made by the government or any other employer in the previous year to the account of the employee under a pension scheme. Suppose there is a pension scheme, now there is pension scheme notified by the central government. Any contribution made by the government or other employer, not only government and non-government employees, to the pension fund of the employees, that shall also be included under the head income from salary. So, let us see, contribution made by the employer, by the government or any other employer to a notified pension scheme of the central government, that shall also be included. So what all includes salary? Salary includes wages, then comes annuity or pension, gratuity, then fees, commission, perquisite or profit in lieu of or in addition to salary or wages, advance of salary, then any payment received by an employee from his employer for the amount of in respect of any period of leave not availed by him, then annual accretion to the credit of the employee participating in a recognized provident fund. That is contribution made to a recognized provident